Hey guys, hope you had a great weekend after a tumultuous week last week where we ended up positive after that nice big sell off on Monday. If you got any good deals, congratulations, nice move. Starting off with Apple this week because their new iPhone just came out on Friday. Already there are delays of about a month and a week or so if you want to get most of the models on the Pro or Pro Max. Average selling prices are much higher than previous generations of iPhones, so margin expansion is likely. Also, I want to look at the chart on Apple too because it's pulled back a little bit. It pulled below their previous all-time high, which was support right over at 145.09. We saw that on Monday. We pulled back below that to 141.27. But reclaim that support line of 145. That's pretty bullish short term. I think we have a nice pathway to around 150, possibly 155 again, all-time highs by their next earning report. Now, looking at Apple from a logical standpoint, based on their average selling prices of the iPhone and the delays in terms of if you want to order it now, you need to wait about a month, at least in Canada. I haven't checked the US, but in looking at the iPhone right now, when you buy one and you want to buy Apple Care Plus, their insurance plan. So if you break your phone, you can go in and replace the screen at a lower price. They're actually having a lot of people sign up and pay for that monthly fee of $13 a month in Canada to buy the Apple Care Plus. Right, so basically, they're generating income passively on iPhones, even when you're not paying for the phone itself, right? Additionally, a lot of people are using their version of Afterpay or the buy now pay later model, where they're pretty much splitting up the overall cost of the phone into 24 monthly payments at 0% interest, which is pretty sweet for people that want to buy a new phone and not drop $2,000 in one shot, right? So Apple has a lot of things going for them. Their service businesses are growing every single year. They're releasing new products. Their wearables is growing a lot as well. And I think that they're still a very strong buy. I think they're going to keep on doing very well. Apple TV Plus, though its library isn't very massive, the quality of the content is pretty top notch. Ted Lasso, they have the new Foundation series that just came out on Friday. The morning show. So I'm pretty bullish on Apple long term. And again, this is kind of one of those stocks you can probably throw in your portfolio and let it sit for 10, 20 years. And year after year, they're going to keep on doing well, just simply because they have such an arsenal of products, and also they have amazing financials, right? When you have that much cash available to you at all times and credit as well, you can do pretty much anything, right? You can acquire almost any company, right? Outside of the Fang Man names, right? So they have a lot of optionality in how they run their business, and Tim Cook is a master with the supply chain. Speaking of which, supply chain issues seem to be popping up around the world in every single industry. So just anecdotal, but I was buying cigars for a friend for his birthday yesterday, and I had to pop to a few different shops because many of them were sold out of cigars. The owners were telling me that they haven't received shipments in months. They don't know when they're actually getting shipments of cigars. So one anecdote. Another one is that home appliances are delayed by about 18 months right now on average. So if you buy a new house, you need to wait for your dishwasher, your stove, your fridge, your washing machines. That's not good for the economy at all, right? And obviously in Canada right now, we have wheat shortages due to the poor yields from the crops out west due to drought, right? So that will get passed on to consumers of beef, especially because obviously cattle consume wheat, and that means in all probability we're going to see more inflation across multiple different sectors that you wouldn't normally think about. So this could be a hindrance to the economy in the short term, given that people will be spending more money on the same basket of products they usually buy. And so looking at the markets, again, last week I mentioned we sold off pretty heavily on Monday. I was on vacation, so I wasn't really trading it all last week. But I was watching, from my phone, and seeing the nice sell off on Monday. It was a nice pullback that was required, I would say, especially on the Qs and tech. But we recovered all that in only 4 days and closed the week positive, which is very interesting, right? Also, the Fed was talking about tapering as well last week, and raising rates earlier than expected. So now apparently they'll be raising rates in 2022, which means we should see some more volatility in the markets. But again, I think the FANGMAN names are where you want to park your cash because they do well in any and all environments, right? Like think about it, Google doesn't have supply chain to worry about, nor does Facebook. Apple does, obviously, right? But they're growing their service business, which doesn't have supply chain as well, right? So that in the long run will keep on growing over and over again and compounding annually, right? Netflix, same thing as well, no supply chain there, right? AMD, obviously, their supply chain. NVIDIA, same thing as well. There are chip shortages, but they're trying to work that out. And then Microsoft, obviously, too. Again, no supply chain, right? So you want to invest in corporations that have none of these issues at all. And so a lot of the FANGMAN names fit the bill. I think they're all pretty solid buys overall, outside of maybe Facebook and Netflix. Facebook had a pullback last week. Mark Benioff, CEO of Salesforce, mentioned that he thinks that Facebook is the new cigarettes, which I don't disagree with at all. I mean, it's a big time waster. A lot of people are using, most of their time spending it on Instagram and Facebook, and that's not a very productive use of your time, right? You want to spend your time learning new skills and enhancing yourself, right? Not flipping on your phone, scrolling through everyone else's highlight reel of their lives, right? Which can create depression and obviously that also hinders productivity in the long run as well, right? So I would say trade cautiously the next few weeks as well, because we're entering October obviously on Friday. But again, looking at SPY, we held that 430 area, popped back up, filled the gap on the pullback on Monday, and who knows where we go from here, right? We might trade sideways for a bit. It might not be a bad idea to look at some straddles perhaps with IV low on 0 days if you're trading 0 day contracts. So Monday, Wednesday, Friday, for example, on SPY, QQQ, and IWM, you can trade straddles 0 days. Again, they're kind of risky because you need to be watching them all day. If you have a full-time job and you can't monitor your positions, I would not suggest doing so whatsoever. But otherwise, you can catch some nice moves on volatility increasing after you purchase position. So for those of you that are new to straddles, I'll just give a little example and then we'll cut off short here and do some Q&A. 1 second, let me pull up an option chain here. So let's look at SPY. 1 sec, here it is, guys. Bear with me here. So we have SPY, and for this coming Monday, so tomorrow, right, 27th of September, current price 444. If you were to buy the at the money call and put right now, or on Friday at close, it would have cost you roughly $260 or so, right? So you're buying the at the money put and the call. Sorry, the puts over here, calls over here. Current debit would be about 260 overall, which means you need a move up or down, either direction, doesn't matter which direction, of 260 to win on this trade, right? Now, what you could do is wait till midday around 11:30 a.m. after the IV settles down and the morning movements subside, and this price might go down to around $2 or $1.80 or so, right? Which means that you need a much smaller move in one direction to make a profit on the trade, right? This is just an example. I'm not saying go and do this, right? Obviously, this is just an example. And essentially, if you get a move like we had on Monday where SPY pulled back, $8 or so from the top to bottom, you make basically $8 or $7 out of $2 or so, or 260 or so, right? So, and again, you're directionally agnostic. You don't care what direction the market moves, up or down. You're happy with a big move in either direction. You don't care, right? So, Friday, for example, I did this on AMD and worked out nicely. Apple as well worked out, not so well. I exited too soon on my call side. It would have been profitable overall, but this is a strategy that if you understand what you're doing with options on 0 day contracts, you can do pretty well on them. Again, if you don't understand what I'm talking about here, I would maybe practice in a paper account or do some more research online and analyze how the strategy would be beneficial in environments where you're buying low IV midday, perhaps when there's not much movement, kind of like with Apple, for example, followed by a nice movement in one direction. So Apple, as an example, I'll just show you guys Apple again. Friday's movement, it was pinning around 146 all day almost. And here's a chart again. So 1 day, 5-minute chart. So opening range, it traded in a pretty narrow range all morning, basically, between roughly 146.30 and downside was around 145.80. So about 50-cent range all day, right? So the implied volatility was shrinking for the Friday expiration contracts, right? And what happened was that when it was pinning 146, the 146 calls and puts just kept on eroding in value gradually, right, over the course of the day. So midday at around noonish, you could have purchased the straddle for 75 cents, right? That was around the low of the day on the straddle price, right? And what happened is it took off later in the day, hit a high of 147.48, meaning that your calls alone would have been worth $1.47 or $1.48 or so, right? So you could have made almost double your money roughly on the straddle. Again, if it was flat and stayed in this range all day, which is, you know, improbable, you never really see Apple stay in a 50-cent range all day long, right? You would have lost. But the nice thing is you can cut your losses by simply creating a stop loss on the straddle position as a whole, because you own the call and the put. So your only real threat is that it pins around the strike price of 146 in this case, in which case you gradually just erode value to theta, time decay, right? So each hour or so you lose, you know, a few cents here and there. At a certain point you stop out, which is what happened to me, right? It happened to me right around over, I think it was around 2 o'clock. I got out right around here for a small loss. And then it popped up to 147.40 right after that, right? So this can be a very powerful tool to use, especially in volatile environments where you're not sure what the direction is in the market as a whole. Nice thing about SPY, IWM, and Triple Q are that you can trade them Monday, Wednesday, and Friday because they have 0-day expiration on Monday, Wednesday, and Friday for those ETFs. For everything else, Friday expiration is not bad to look at, and you want to look at names that have high liquidity. So Apple fits the bill, obviously, because you're buying both the call and the put, right? And if you have the liquidity, you're gonna have wide spreads on the contracts. So, you know, for example, if you try doing this with a different ticker, let's say we look at like hack ETF, right? Something random, right? Which is the cybersecurity ETF. So for one, if you notice here, they only offer monthly OPEX. They don't offer every single week, right? That's one issue. But if you look at the spreads in the contracts, because there's no volume and no open interest, the spreads are pretty wide, right? If you find a ticker that has weekly OPEX but has low liquidity as well, you might have, for example, Biogen or something like that, right? Like Biogen, they have weekly OPEX, but if you notice, the volume is low and the open interest is almost non-existent. And what happens? The spreads on each contract here. So, for example, current price 290 or so, right? As of Friday close. If you're trying to do this strategy on Friday this week, your spread on the call side is about 80 cents wide. On the put side, it's about 50 cents wide, right? That's too much slippage to incur. So again, you want to avoid any names that have low liquidity, so low open interest, right? And you want to focus on names like Apple, for example, Microsoft, SPY, Triple Q, IWM, names that have ample liquidity. AMD is one of them as well. But avoid at all costs anything that has low liquidity. And this is, you know, a rule not just for straddles, but for everything you trade at all, right? It doesn't matter if it's an option, a commodity, a bond. The lower the liquidity is, the harder it is to trade the asset, right? The more liquidity that exists, easier it is to trade as well, right? Less slippage is good. That's what you want, right? So I'm going to end it there. You know, we can do some Q&A for about 20 minutes. And if you have any questions at all, drop them below. Have a great week, trade safe, and I'll talk to you guys next week, okay?